Welcome to Value Vest Daily. Today, we're tackling a massive story that has every single investor on the edge of their seat, the market's absolutely wild reaction to the military escalation with Iran. We saw this incredible swing, from pure panic in the morning to a rally by the afternoon, and it's left a ton of people asking, what on earth comes next? So what does this all mean for your portfolio? Let's dig in.
If you just looked at the closing bell, you'd think so. But the morning? That was a completely different beast. We saw a sea of red right at the open, followed by this powerful, almost defiant rebound. So what's really going on here? Did the market genuinely just shrug off the threat of a major war? Or is there something way more complex happening just beneath the surface?
These numbers right here tell a story of two totally different days packed into one. The S&P 500 opened down a jarring 1.2%, a classic panic move. But by the close, it had clawed back every single point of that loss to finish slightly up. It's this exact kind of whiplash that makes investing during these moments so challenging and, frankly, so emotionally draining. So, to make sense of all this, we're going to break it down into 4 parts. First, we'll dissect today's wild ride. Second, we'll pull out the history books and see what the geopolitical playbook tells us. Third, we'll game out 3 possible future scenarios for the market. And finally, we'll boil it all down to the key takeaways for you, the investor.
Okay, first up, today's market whiplash. We need to understand the fear that sparked that huge sell-off, and then the logic that fueled that surprising rebound.
So, the trigger for all that morning panic was severe. There's no other way to put it. Over the weekend, joint U.S.-Israeli strikes blew up into open conflict, targeting key Iranian leadership. Then we got these shocking reports that the supreme leader himself might have been killed, followed by Iran launching counterattacks. To top it all off, President Trump signaled this wasn't going to be a quick one-and-done event, but a multi-week operation. For the markets, that is the literal definition of massive uncertainty. So how do markets react to that kind of uncertainty? Well, it was a textbook risk-off move. Stocks sold off, especially in sectors that are super sensitive to things like fuel costs and consumer confidence, like airlines and cruise lines. They got hammered. At the same time, investors fled for safety, causing the price of oil to just explode higher as everyone worried about supply getting cut off. But that was really only Act 1 of the day's drama, because just when it looked like the bears were totally in control and the story for the day was written, the market just flipped on a dime and a really powerful rebound started to take shape. And this shows you smart money on the move. Investors didn't just blindly buy everything back, they rotated. Money flowed out of those vulnerable consumer stocks and into sectors that looked a lot more resilient. Big tech leaders like NVDA and Microsoft, they're seen as pretty insulated from this. Defense contractors, for obvious reasons, saw a huge surge. Energy companies actually benefited from those higher oil prices. And of course, the classic safe haven in times of trouble, gold, really shined. All right, on to our second section. As shocking as today felt while it was happening, this pattern, panic followed by a calculated recovery, it's actually not new. History gives us a surprisingly clear playbook for these kinds of events, if you just know where to look. Think about it. Whether it was the Gulf War back in '91, the Iraq invasion in 2003, or even that more recent Soleimani strike in 2020, we have seen the script play out before. You get this initial, sharp, fear-driven drop as everyone sells first and asks questions later. But that is so often followed by a surprisingly fast recovery once the dust settles and people can actually assess the real economic impact. And this one number says so much. On average, it takes the S&P 500 just 42 days to fully recover its losses from a major geopolitical shock. Now look, every situation is different and past performance is never a guarantee, but this historical data strongly suggests that these events are usually short-term bumps in the road, not long-term catastrophes for a well-diversified portfolio. So why does the U.S. market bounce back so consistently? Well, it really comes down to fundamental economic resilience. See, unlike the oil shocks back in the 70s, America is now a net oil exporter, which gives us this huge internal cushion against price spikes. The underlying economy is still strong with low unemployment and this powerful AI-fueled earnings growth. And this is crucial, the Federal Reserve has the firepower to step in and cut interest rates if things really get bad. And this historical view is echoed by seasoned pros like Steve Eisman. You probably know him from The Big Short. His take on this whole thing is pretty blunt. Ignore the short-term noise. He even makes this really interesting counterintuitive argument that there could be a long-term positive here. He suggests that if this conflict leads to a more stable regime in Iran, it could actually lower geopolitical risk for decades.
With that crucial historical context in our back pocket, let's look forward. In part 3, we're going to analyze 3 different future scenarios to really understand how this conflict could shape the market's path from here.
The outcome here is not written in stone. It's going to depend on these key variables that we all need to be watching. Are we seeing any diplomatic progress? Does the price of oil stay this high? Are there any disruptions to the Strait of Hormuz where so much of the world's oil flows? Does the conflict spill over to other countries? And crucially, do other big players like China or Russia get involved? So this table here helps lay out 3 possible paths. The most probable scenario, with about a 60% chance, is a quick containment of the conflict. In that case, oil probably settles back down, and the S&P 500 could see a nice 5 to 10% relief rally. The main downside scenario is a prolonged regional war, about a 30% chance, which could pull the market down 5 to 15%. And then there's the wild card, a successful, though less likely, regime change, which could unlock a huge stability dividend and an even bigger rally of 10–15% or more.
And that potential long-term upside isn't just wishful thinking. It's echoed by major figures on Wall Street like Jamie Dimon. He acknowledges that while the short term is obviously risky, a fundamental change in Iran could seriously reduce long-term risks around terrorism and oil supplies, creating what he calls a meaningful chance for peace and a much more stable environment for global markets.
Okay, this brings us to our final and honestly most important section, turning all of this analysis into some actionable takeaways and a clear-eyed view of the risks. So here's a potential playbook for navigating this kind of environment. First, and most importantly, try not to panic sell into that initial fear. History is clearly on the side of people who can hold their nerve. Second, make sure you're diversified. This might be a good time to look at your exposure to sectors that could be resilient, like defense or energy, or traditional safe havens like gold. Third, watch those key indicators we talked about. If oil prices can get back and stay below $85, that's a very green light for the broader market. And finally, think about using this volatility not as a threat, but maybe as a chance to add to your long-term positions at better prices. And of course, just a quick reminder for everyone, this is all for educational purposes. It is not financial or tax advice, so please be sure to do your own research before you make any investment decisions. And that leaves us with one final important question to really think about. As we navigate this latest crisis, it kind of begs a bigger question. In this increasingly fractured world, is this kind of geopolitical chaos and the market volatility that comes with it, is this just the new normal? It's something for all of us to really consider as we build our long-term strategies. Please subscribe, like, and share ValueVest Daily for daily learning opportunities before you put your money to work. And one more thing, please put in a comment if you want us to deep dive into any specific high-risk/reward opportunities.